I'm back today with the second installment of the portfolio building series. In the last video, we built a portfolio for decent dividend yield, so check that out if you're interested. But this time, we're going to build a portfolio consisting of only companies that pay a dividend every single month of the year. And this is not financial advice, and nor is it my own portfolio. This is only for fun. And wait until the end of this video, as I'm going to share how much money you'd get in dividend payments from the portfolio that we're going to make on a monthly basis and a yearly basis if this portfolio was worth $10,000. The first company that's going to make it into our portfolio today is Realty Income. And this is a company that has quite a name for itself when it comes to monthly dividend payers. Realty Income, if you didn't know it already, is a REIT, which means a real estate investment trust. And they own over 6,500 properties on a long-term lease agreement. So this means that the company is getting regular and nice cash flow, which they're then giving some of that to the investors in the form of dividends. So we're on Seeking Alpha now, which is where I primarily do all of my stock-based research. So if you want to check that out, I will leave a link in the description below. But you can see the yield for Realty Income is 4.88%. So that's a pretty good yield. But what I want to know from a company that pays dividends is, are they able to sustain and grow their dividend yield? So what we're going to do is we're going to go to the dividend tab here and just take a little look further into this. So if I scroll down, you can see that the dividend growth for this company is 26 years, and that is really impressive. That means that they've been able to consistently grow their dividends year on year on year without breaking that for 26 years. That indicates to me that this is a pretty strong dividend growth company. So we can look into this in a little bit more detail. So let's actually go to the dividend growth tab here. And if we scroll down, we can see a 10-year time period for dividend growth charted out, but we can also see a table with many, many more years. And what I want to point out here is that throughout Realty Income's 52-year operating history, they have managed to increase their dividends 109 times. Another thing that I really like on Seeking Alpha, just one of their many features, is this news section. And this tells you all the latest news about any company. And what we can see here is news that Realty Income has risen their monthly dividend by 0.2%. And that was on the 14th of March. So they just continually increase their dividend payments. So as someone that is making a portfolio for monthly dividend paying stocks, this seems to be a pretty good one to have. So now let's just take a look at their performance. So if we go back to this page here, we can see that over the last 6 months, they've had a decent performance at 9.24%. Year to date, they're down by just under 2%. 1 year, again, not great. They're down by 12.4%. But if we start zooming out now, a 5-year picture, 10-year picture, and maxing it out, you can see that they've had a pretty good growth. I've decided that Realty Income is going to make up 40% of our entire portfolio today. And the reason that it's getting 40% is because, in my opinion, this company has quite a good performance, and we'll look at that compared to the other companies later on. But also the dividend seems pretty safe. We saw that they were able to consistently grow their dividends for 26 years in a row. That is quite impressive. And also, if we go back to the dividend tab here, you can see that the dividend safety, if we click in the dividend safety tab, has been rated by Seeking Alpha as a B-, which is a pretty good indication that they don't think the company is going to cut their dividends anytime soon. Now, this dividend safety indication is basically formed from 13 different financial indicators that they use. And it just gauges the risk of whether this company may cut their dividends in the future. It's not the only thing that you should go by, but it's quite a good indication to have. The second company to make it in our portfolio today is Main Street Capital. This is an investment firm that actually provides debt and equity financing to small and mid-sized US companies. The dividend yield for this company is a little bit higher than what we saw from Realty Income, and that is 6.88%. And like I said, when we see these higher than average dividend yields, you want to be asking yourself, is this sustainable for the future? Because what you don't want to do is you don't want to build yourself a portfolio for dividend paying companies and be expecting a certain amount to come in each and every month. And then in a few months' time, a few years' time, that gets completely cut and you're kind of back to square one. So you do want to take the dividend yield with a pinch of salt and always do further research into it. So let's just have a look into this company. So we'll go to the dividend section And we can see here that the dividend growth is only 2 years. So that is indicating that they've not been able to consistently grow their dividends for more than 2 years at this current time. But we do need to look at that in a little bit more depth. So we'll go to the dividend growth section like we did earlier, and we'll just scroll down and see what's going on here. So, okay, what we can see is that they have been growing their dividends year on year, but in 2020, they actually cut those dividends, which isn't really surprising given what was going on in that world. And then since then, they've been gradually increasing them. So for the past 2 years, they have been growing them. That's a good thing to know, because it's not exactly that they've been cutting them up, down for, over a course of loads of years. It's not that inconsistent. They have been growing them. And then 2020 came, they had to cut them. Fair enough, really. And then they've been growing them since then. So that's why you want to do further research to know actually why they had to cut them in the first place. So we're just going to have a little look into the financial section of this company, just to see what's going on their balance sheet and with their revenue. So we can see here that their revenue has been increasing for many years. So they've been an increase from 2015, 16, 17, 18, 19, decreased in 20 again. Given what was going on in the world, I'm not that surprised. And then increased in 2021, increased in 2022. So that's a good picture. And I think the gross profit is following a similar story here as well. Another thing that I always like to look at is the net income. So we can just see that that has been increasing from 2015 to 16 to 17, decreased 18, decreased 19. Okay, so that's been a little bit more all over the place. So seeing that would make me want to do some further research as well. So now let's just take a look at how this company has been performing. So we'll go back to the summary tab here. 6-month period, they've had a really great 6 months. Look, up by 21%. Year to date again has been pretty good, 6.8%. 1 year, not so great, down by 4.37%. 5 years, good. 10 years, good. And again, we're going to compare this to all the other companies at the end. Seeking Alpha has rated the dividend safety for this company as a C+, so not as strong as Realty Income. And with this information combined with everything else that we've looked at, I'm going to allocate this company 20% of our portfolio today. This is half the allocation that Realty Income got, and that's because I think there's a higher chance of them cutting the dividends in the future. And like I said, this portfolio is for fun, but we're making it up with the intention to have monthly dividend payers only. So we want companies that we can trust to keep paying us dividends month on month on month. The next company in our portfolio today is Stag Industrials. And just like Realty Income, this company is also a real estate investment trust, commonly known as a REIT. This company specifically is focused on the acquisition, ownership, and management of single tenant properties. And they operate throughout the United States. So think about things like warehouses, manufacturing buildings, logistic buildings, distribution centers, things like that. The dividend yield of this company is 4.47%. Let's just go to the dividend tab and just see this in a little bit more detail. So they have consistently grown their dividends for 11 years in a row. So that is pretty impressive, not quite as impressive as we saw with Realty Income, but this is a good picture. Let's just have a look at the dividend growth as well in a little bit more detail. So we can see that, they have just been consistently growing their dividends, and by quite a nice amount. Some of these actually, they've been quite big increases, especially back here. Dividend safety has been rated as a B-, so that's quite a good sign. Let's just take a look at the financials as well. So I can see here that the total revenue has been increasing year on year most years. The net income seems to be a similar picture as well, a little bit up and down some years, but in general it looks quite promising. When you're researching and you're analysing normal companies, so companies that aren't REITs, you tend to look at things like the PE ratio and the earnings per share. Those indications, those ratios aren't as helpful when you're looking at REITs. However, there is one particular thing that you can look at, FFO. That stands for funds from operations. And it kind of gives investors a more accurate picture when it comes to REITs of recurring income. It gives an indication of the REIT's cash flow, if you will. And then that information can help you think about how safe the dividend payment may be. So taking a look at this company's FFO, we can see that it's been increasing year on year on year, which is a good picture. We can also see some other things related to this. So the FFO payout ratio percentage and the AFFO if you are investing into REITs or you're interested in investing into REITs, definitely go and learn about these different financial indications and look into them. Try and understand them so you can make the best decision for your own portfolio. Another thing that I just want to point out about Stag Industrials before we move on is that they have quite a diverse client list. So only a small percentage, so 17% of their rent actually comes from the 20 largest tenants that they have. One of the largest being Amazon, which makes up about 3% of their rent that comes in. But apart from Amazon, none of the other clients that, as far as I'm aware of, make up more than 1%. And I quite like that because that means they're not reliant on just one or a couple of businesses to actually pay them the money that they need, which of course means if one of them goes, it's not the end of the world. They have other companies that they can rely on. So just taking a look at their performance now, 6 months up by 22.5%. Year to date, they're up by just under 2%. 1 year, not so good, down by 17.7%. 5 years up, 10 years up. And if we max it out here, you can see the performance over time has been pretty decent. Looking at their dividend safety, they have been rated a B-. So with all of this information in mind, I've decided that Stag Industrials will make up 30% of our portfolio. And that's because the dividend doesn't seem as reliable as Realty, but it seems better than Main Street Capital. The last company to make it into our portfolio today is EPR Properties. They own and operate quite a diverse portfolio of properties. They have everything from theatres to retail centres to golf complexes, even things like ski resorts, water parks, schools, you name it, they probably have it. They seem to focus more on those tourism-driven properties. EPR Properties are structured as a triple net lease REIT. That was quite a mouthful. But that just basically means that their tenants are responsible for paying operating expenses, taxes, maintenance costs, insurance. And this just means that the company itself, so EPR Properties, have more of a stable income stream and they can minimize their operating costs a lot. This company has a dividend yield of 8.5%. Now that is pretty high. So again, I would be asking myself the question of, is this sustainable? Let's go over to the dividend tab. Okay, that makes a bit more sense. So they have 0 years of dividend growth. Let's go to the dividend growth section and have a look into what's been going on here. We'll go to the 10-year time period. So from 2013 up until 2019, they were actually growing their dividends, and perhaps even further back than that, which you could look at with this graph here, with this table here, sorry. But in 2020, they cut their dividends by a lot. A massive amount, and then since then they've been trying to grow them back, but they actually then cut them between 2020 and 2021, then had an increase between 21 and 22, hence the 0 years of dividend growth so far. Just having a look at the FFO on the financial tab, we can see that it's not consistently growing every single year. So if this was a real portfolio, I'd definitely be doing more in-depth analysis. So now I thought it'd be interesting to look at the performance of these 4 companies next to each other, so we can just get an indication of which companies have been performing the best over a long period of time. So if you see here on a 6-month time period, it looks like Stag Industrials and also Main Street Capital have been doing the best, but 6 months is a really short time period if you're building a long-term investment portfolio. So let's just zoom out to a 5-year time period. Okay, we're seeing a little bit of a different picture here. We're seeing Stag Industrials and Realty Income being the ones that are doing the best. We can max it out and look at that, but it's difficult to do this because not all of the companies went public at the same time. So it's a little bit unfair just to look at it like this. But I would say that what we can see here with all the other information is that Realty Income is probably the clear winner. So this means that EPR Properties is going to make up the remaining 10% of our portfolio. And this is because, well, we've got 10% left, but also the performance and the dividends are not as consistent as the others that we've looked at. On the screen now are all of the companies in our portfolio and their target allocation. Now let's look at this portfolio as a pie and see how much of the $10,000 that we have will be going into each of the companies. So we said that Realty Income is going to make up 40% of this portfolio. So Realty Income is going to get $4,000. Main Street is going to be 20%, $2,000. Stag Industrials 30%, so $3,000, and EPR Properties just 10% of our portfolio today, so that means they get allocated $1,000. So now let's see how much you would get paid in dividend payments per month and across an entire year with this portfolio. And remember that from this portfolio, you would be paid 4 times every single month. Realty Income, we have $4,000 to spend, and this will get us 64.3 shares using the current share price. You'd get 90.6 shares of Stag Industrials, 50.9 shares of Main Street Capital, and 26.1 shares of EPR Properties. And we'll now use the latest dividend amounts per share to do the following calculations to tell us exactly how much you would get in dividend payments. So Realty Income will pay you $16.40 per month for the number of shares that $4,000 will get you using the current share price. Stag will pay you $11.10 per month. Main Street will pay you slightly more, $11.45 per month. And ERP Properties will pay you $7.18 per month. This means that very simply put, not including any commission fees, any withholding tax, any FX fees, no acknowledgement of dividends increasing, as this is just for fun, you would get $46.13 per month, which would work out as $553.56 across an entire year. One good thing with this portfolio is that we have built it using monthly dividend payments. That means that you can assume a stable and steady cash flow of dividends coming in 4 times every single month. But there are downsides about this portfolio, and that is that there's a very limited amount of companies that actually pay on a monthly basis, and these tend to be primarily REITs. As you saw from this portfolio, 75% of the portfolio was made from just REITs. And this, of course, means that there is going to be a lack of diversification. A lack of diversification across sectors, companies, but also geographical. If you're someone that is really serious about investing and you really want to start chatting with like-minded people about stocks, about your portfolio, all things personal finance and investing, then consider becoming a Patreon. I'll leave a link in the description below. You'll also get live movements anytime I sell, anytime I buy inside of my own portfolio, before I put that information on YouTube. Thank you so much for watching this video, and I'll see you again in another one very shortly.